Comparative analysis. A good study on the Nasdaq futures on a 60-minute time frame. When we use this form or type of analysis, the first thing we need to do is to take a macro view of the chart. So we don't focus if we're here live or here live. We don't focus here. We need to take into consideration the whole of the chart, as we do for the majority in this trading methodology. And volume has been removed so we can solely focus on the price action. It's good. It's a good habit to get into as part of your practice. So what do we note? So to A, good drive down, break support, local support here, widespread closing week, another widespread closing week on the lows. Clear to say here to A that sellers are in control firmly. Then to B, what do we note from B? Well, again, we get a good move down, but the selling pressure is less than we see from the move to A. We can see that these two bars, there's greater selling pressure than there is on these two bars. Yes, we can see this spread has shortened. Okay, closes still off the lows, and this is, of course, is weak, but it's not as weak as the original drive down to A. And what else can we see here? Shortening of the thrust. Good. And to C, A, we push down, drive up. To B, we push down, we drive up, and now we're comparing C. Now C is interesting. Clearly, the selling pressure has ceased. We do not get ease of movement down here like we see here and here with the wide spreads closing weak on their lows. Now think logically and deeply about this push down to C. What do you notice? Well, I'll tell you what I notice. We have these 1, 2, 3, 4, 5, 6 bars here on this move down, which is 3 times the amount of bars then it's taken the market to push down to A and to B. So with more time, we make less progress, and the price action is poor. We have a down bar, an up bar, doesn't net anything. Then we have another bar that pops its head above, doesn't break the lows, with down bar, another up bar. We're struggling to do anything here. There's no real conviction of selling like there was here, 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 and here. Very important data to understand and just recognize this behavior. This push or pulse down to C is the smallest push or pulse that we've seen, with 3 times the amount of time. So previously, the market's made its move down with only 2 bars. So the price action has changed significantly, and we can see that in the spreads. Look at the size of these spreads. See the attempts to push down here. Clear as day. Although we have recognized this behavior, there is nothing to do as yet. Demand has yet to prove itself. In fact, has become weaker comparing the rallies from 1 to 2. So although we've noted that the selling pressure has ceased, we would also analyze this buying here and this buying here. So this buying to 1 is better than this buying to 2. So although we've seen selling pressure cease, we still need demand to prove itself. And then what happens? Boom. We get a push up to 3 with evidence of good demand. Dips under all this action, reverses to close firm practically at the highs. I mean, this bar even rivals this down bar. So this is the best buying on the chart. It's the largest up bar that we can see on the chart with this amount of data available. Okay, there may be other further bars to the left, we haven't got access to that. Only what we can see here, this is the best buying on the chart. Importantly, after we see that the market is struggling to go down. And this bar here, so the drive to 3, it does break a local resistance area. So the drive up, demand has proved itself with selling that has eased off prior to this move. So this is demand proving itself after this weak drive down when we compare it to this and this. This doesn't mean we go long. We have merely noticed the subtlety. A shift of sentiment has occurred. There's a change in the behavior. Supply is drying up, with demand now proving itself on this bar. So now our ears are perked. We're looking for a potential trade. And where we look for a potential trade would be some kind of testing in this high volume bar, as we know. Excellent. And then, so from 3, from up here, the highs, we drop down to 3. We attempt to rally before falling to E, where the market halts. We halt here, it stalls. At this point, we need to analyze. And what do we notice? Well, the fall to E, comparatively, using our comparative and contrast analysis, when we analyze the selling from from 3 to D, and then from here to E, because this is an attempt to rally, we've noticed that the selling has weakened. Spreads have narrowed. We're not getting the down bars like this closing week. We're not achieving anything great on this move to E. This is very important to understand. We will compare this move down to E to that of A and to that of B. And we can see that the selling quality clearly has decreased. But our main objective for comparative analysis is from 3 to D. Now, why would that be? Why are we keen on focusing on this price action to this price action and not to this price action or this drive down? Well, it's because of this bar here. This bar is very significant. Here, demand has proved itself in a big way. So we want to pay close attention after this move has happened. We want to see the selling quality left in the market. So as we come down here today, we can say, okay, there is still some selling left in the market, as we can see. But then as we come back down lower, we can see that the selling quality has certainly decreased. We want to pay close attention because sellers here to A, to B, to C, sellers are in control. And there's a big difference. I know it may seem confusing. So let me just sum this up. From A to B to C, we're using compare and contrast before any of this. And we've noticed that supply is drying up. Then we get this move to 3 with a huge widespread up bar. This is telling us that demand is in the market, and we even break this high. We're penetrating deep into this supply bar. So demand is present. Now, as we react from here after demand has proved itself, we want to analyze the quality of the selling. And this is a push down, attempt to rally, and then we analyze another push down. So we're comparing this E to D, and we can see that the selling pressure has deteriorated. Yes, we will also note that we're not getting the wide spreads like we did here, but that's a different playing field. It's a new game because we're looking at the selling after demand has proved itself from the move to 3. Okay, I know this may sound very confusing, but it's very important to understand that we do use compare and contrast in various scenarios. Once again, sellers lose force. Demand proves itself. Then we analyse, move to here, to here. Good. There is also another important comparative analysis to do here, and that's the fall to C and the fall to E. They are in the same area on the chart. So we use our comparative analysis. And what do we note? Well, we note there's no selling pressure. But if we note from here, we're holding here. All this time here, we are holding this level of support. Don't forget these are 60-minute bars. So that's 1, 2, 3, 4, 5, 6, 7, 8. That's 9 bars. If you think of this on a 5-minute time frame, that is a 9 into 12. That's nearly 100 bars within a trading range. Okay, if we think in multiple time frames, if this is our trading range here, and if we split each one of these bars is 12 bars, so it's near on 100 bars within this trading range. And what do we have? Here, this bar is a hidden test, but on a 5-minute time frame would be a spring. Very good spring. And these two, we don't have volume, but these two bars here, we may see no supply. We could see, for example, we could have volume here on the spring, and we push up volume like this, and we come down here, very low volume. And so this is just a mere test. Again, that's hypothetical. We don't have volume here. We want to solely focus on the price action. But thinking in multiple time frames will help you here. And this gives you a very good entry. As we've noted, the move from C to C and the move to E, we're in the same area where demand proved itself. This, look, we think we'd be going to the, we think we'd be going down from C. Bang. What happens? This bar dips under, reverses, close firm, and we take off to make a new higher higher. We come back down into the same area. As you can see, demand. Come back down. Think we might go lower again. Instantly resolve. Buying. Buying. Dip down. Buying. So we're in this area. Must be some form of accumulation. Some form of buying. And then the market breaks out. So from this trading range, the market breaks out and we rally to 4. What do we note at 4? No real demand. We can see narrow spread. This could be overnight action. Makes no difference. There's no real demand up here. And where are we? We're in an area of supply. Selling. 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 So no demand in an area of supply. We would expect a reaction. And consequently, we do fall. However, as we react, there is no evidence of supply. As we react from here, if we just draw this in, as we react from here, where is the selling? We saw here and here on our move down. So although there's no demand, there's also no selling, which is very, very important. Why? Well, because we've established this is the accumulation down here, some form of buying here, mini trading range. We break up, we come up into the highs, no demand. We're in an area of supply. We expect a reaction. We come back down. There is no ability, there's no selling force driving this market down. Then we have this little local level here. And we see evidence of demand at F. Good buying. Then we test and we take off. Test here and we take off, breaking the highs and we're into new highs. Good. The question remains, how do we trade this? And again, we must add structure. So as we add structure, we can go through the trades. Well, the first trade that sticks out like a sore thumb is 3. This is an upthrust. And would we trade this upthrust? Because we do have direct strength behind us. And the answer is yes. We have to trade this upthrust. Why? Well, because we are coming in to an area of supply. We are at this high, so this would be our natural resistance level, and we drive up find no further buys, reverse to close down on its lows with an increasing spread over the previous bar. This bar here is a negative bar in a previous area of supply at resistance, and our target would be the lows. Using logic, we now know from our previous sessions that the market likes to test high, or should I say here, a wide spread bar. A reaction here is on the cards. We're already thinking it's very unlikely. I'm not going to say it's impossible, but it's very unlikely that the market will come down to test this bar at some point. We're not just going to dip here and then take off and never look back. It's extremely rare that that happens. So we know the market likes to come back down to test. So this is an opportunity for the market to turn. And does this make sense? Yes, of course. We're in an area of supply at resistance, increase in spread, weak negative tone, ergo we can take that trade and our target would be down in the low somewhere. If we are short from here, we have a nice wide spread. This gives us validity, or should I say it helps us to hold on to the trade. Then we get a weak rally. We would like to hold on further still. And then we get to here, these two bars here. What's this? Shortening of the thrust. And if we use our compare and contrast analysis, the last time we were down here, we held. Look here. We came down here on this bar, and we're coming down here on this bar. So here we get instantly resolved, and we take off and break to make a high with good demand. And here we see shortening of the thrust. So it's it's unlikely that the market is going to continue south from these two bars after we held from this bar here. So we always use compare and contrast analysis whenever we can. So here we have the same bar coming down, same bar in the same area at structure, which being this support. Fascinating, isn't it? Really, truly is a wonderful tool for us to use. Anyhow, at E, we've previously stated that we can take a trade here on a lower time frame. Why? Well, because this would be, although this is a hidden spring here or some kind of testing action, on a lower time frame, that is a spring. Now this leads us to E. This is another area for potential trade. To be fair, this is fairly difficult to take a trade here on this time frame with no volume, because we want to see these two bars here. However, if we go to, or like I said, we use multiple time frames, and we are using a 5-minute chart, this bar here is a wonderful spring, and we could take that trade. Okay, but for here, it's a hidden test that is successful. We come back down and we reverse here, hold here, and we hold here. We come back down, and then if we can see this bar live in front of the markets and it breaks this high, we just let the market pull us in. That's quite aggressive, and don't forget we pay for confirmation, because our stop would still have to be under here. If we take this hidden test, the spring, the hidden test, the stop's in the same place. We take this, stop in the same place. Our stop is always in the same place, regardless where we take the entry point. Okay, so again, we pay for confirmation, almost double. Always try to bear that in mind. And this leads to F, which is a wonderful setup. It's a lovely little trade. And this happens after a weak reaction at the highs. But if we add a little structure, add a little channel here, what can we see occurring? We fall out of bed on bar F. We come down nice and orderly within the channel, then all of a sudden we fall out of bed, reverse to close firm back in the channel, whilst we're also testing support. So think about this. We are oversold in our channel at support with positive price action. We're unable to react from resistance here, and we have strength behind us. We have good demand. We have good demand, and we're at this support level. So this becomes a high odds trade. If we miss the trade at F, we have another opportunity 5 bars later, which is this bar here, which comes down and it tests in these 2 bars for supply. You know, because they're widespread. Again, we don't have the volume, but we know that there must be activity because that produces the spread, which incurs there must be volume. And what happens here on this test? Well, we come down, we test for no supply, and we rally back up to close fairly firm in the top third. But what's important about this test is that we bounce off the demand line, a working demand line. As we break past these highs, we can comfortably draw this demand line with 1, 2, 3, and then this bar here will be 4 touches. This becomes a high odds trade. These trades at F and this test bar here may appear a little aggressive, but far from it. We have confidence. Why? Well, by using the comparative analysis from A. What do I mean from A? Well, all the widespread bars here, 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 they are all buying related, and all the down bars, which are very difficult to find. I mean, that is technically a down bar, that's technically a down bar, but they're not closing weak. We're looking for weak down bars, which is here and here and here. So we can safely say that the fact that we can't even find down bars closing weak suggests that the market is indeed weak. But the down bars are very poor quality selling in comparison to good wide spread up bars. So this comparative analysis just from E onwards is again another way to use comparative analysis, and it gives us more data, more information to work with, and hopefully this enables us to pull the trigger at F. If not at F, we must take this trade here because we have additional information to work with coming in the form of structure which we can lean against, and we just place our stop here or under here. Does this action here with the wide spreads and the low narrow spread down bars make sense? Yes, of course, because of all this analysis we have done in the background. Selling has ceased up from A to B to C with demand emerging. We come back down. We see no further selling ability down here. So we have some form of buying. Then as we rally up from the lows down here, we have evidence of good buying and we have evidence of poor selling quality. So when we see good price action like this and this, we must take the trades. Let the market prove us wrong. Good. I can see a question here. Is that a spring near? No, there's no spring here, because for this to be a spring we need to dip under the support anchor, the anchor of support, like this, to reverse and close firm. We need to dip, basically we need to dip under the lows to the left. However, it is a spring. Here would be a spring on a much lower time frame. If you think these are 60 minutes, so that's 12, 24, 36, that's 48 bars here. We're not going to, we would not include all these additional bars for our 5-minute chart, although this low would be drawn in. This would be a spring of this bar here on a 5-minute time frame. That's why it helps to think in multiple time frames. We gain additional trading opportunities. However, I must remind myself that these 2 bars here, a fellow trader from another course mentioned these 2 testing bars, and we are testing down here. And what would we want to see from this bar and this bar for this I know we don't have volume, but what would we want to see? And it gives a very interesting answer. Well, ironically, or we shouldn't say ironically, we would like to see decrease in volume, which would imply there is no supply left in this market. Okay. Alternatively, we'd want the second bar to have ultra high volume, which of course would be effort versus result, or perhaps one may call it bag holding, because with all this extra volume, if this volume produced this bar, the spread, and then this volume here produced this spread, with all that extra volume, we are unable to push under this support level, we know that that must be loaded with buying. So both of these scenarios, both of these volume scenarios are bullish. And this is where it may appear a little tricky, but far from it, because hopefully now you're all beginning to understand the nature of the price bar volume relationship, and that indeed both of these scenarios are indeed strength. What we wouldn't want to see on these bars are either sustained volume, that's hard to read, especially if it's in line or the same volume as this bar. We don't have volume here, but on these two bars we would not want to see sustained volume or slightly increased volume like this, because that spread is slightly larger and this shows that sellers are active. But again, this here is ideal or ideal. So these are both bullish scenarios, and these two would be, I wouldn't want to say bearish because it's it's contextually dependent, but we wouldn't want to see these two scenarios. Good, excellent question. So this concludes the study on the comparative analysis. Let's go on to the next study, which is relative.